Good morning, everybody. It is February 18th, 2022, and the world is waiting on Russia and Ukraine, trying to figure out what the Fed is going to do about inflation. And we have more house cleaning to do at Fundamental Trends and Margin of Safety Investing and the YouTube channel here. First off, this webinar will be switching to Thursday afternoons in late March when I get back from spring training, if there is any spring training. Otherwise, I'll just be in Arizona. And the YouTube channel has added a membership. It started to get too hard to manage some of these, so I added a $1.99 a month membership just to force people who are kind of freeloading on the trading and stock picks. So if you want to see these in real time, and I do release them, right? So they don't stay members only for long, only for a week or two. But if you want to see these in real time, it's going to cost you $1.99. I know, huge on the budget, but we need to do this really to protect the proprietary information and still make this easy to get to and reduce our workload. So for $1.99, you can get the real-time trade notes from Shooter, and you can get my stock picks in video format in real time. I know a lot of people don't use the videos anyway. They just want it in writing. So your membership to the newsletter still gets it in writing. And there's usually a link to the video in there. However, it'll still cost you $1.99 a month to get the swing notes and then some of the stock picks that I want to protect, at least while members are accumulating. So we need to do this for advertising reasons, right? We got to get out there in the world, but we just can't make our workload too much harder than it is already. Already, Shooter and I are using a lot of technological tools and AI, and I've got copywriters and outside research people and 30 investment services that I subscribe to. So this is just, I'm almost apologetic about having to charge you $1.99 for this, but I just don't see that there's any way around it. That said, what do we want to get to today? We want to talk about inflation first. And if you're following along with the narrative is that the Federal Reserve has caused this inflation. I'm going to use a farmer's word here and call bullshit. The Federal Reserve is not who caused this inflation. Inflation was caused by the shutdown of the economy, an economic heart attack that when we came back from, supply chains were disrupted, and OPEC decided to manipulate the price of oil much higher than I think anybody expected. And there's narratives about that too. People running around saying, well, there's not enough research, there's not enough exploration for oil. I've been covering oil for over 20 years now, since 1999. And I will tell you, there is more oil available to be drilled than we will ever use, given that the EV revolution is probably entering the second inning right now. And by the middle of the decade, EVs will be challenging ICE vehicles for which ones are selling more. And by 2030, EVs will be dominating the new car market. So the idea that exploration for oil is somehow leading to these higher prices is bullshit. There is 30 to 50 years worth of oil that we can drill that we already know about. When you take a look at places like Guyana, it proves the point. When you take a look at places in Africa, it proves the point. So why is oil more expensive? It's because OPEC and Russia have conspired to drive the price of oil higher, and the American companies have played along. And probably they needed to, because they were going to go bankrupt otherwise. There is about 3 to 5 million barrels per day of oil that could be pumped within 90 days if the countries and the companies decided to do it. Exxon has already said they're going to do it. Chevron's already said they're going to do it. And quite a few Permian oil players have already said they're going to do it. So at some point in the next year, there's going to be a lot more oil hitting the market. At a point where, in history, we are seeing less than 1% demand growth. I always bring that up because I don't think people really realize it. The oil demand growth is a little bit under 1% and has been for about 7 or 8 years. So there's not this rip-roaring increase in oil usage that people imagine that there is, and that some of the narratives out there make it seem like there is. There is a rebound off of the economic heart attack, but now the line is just smoothing out again. So the point I'm going to make today is that the Fed really can't, in fact, have much impact on inflation. They just can't. And I will tell you right now, I was talking to a CFO of a bank last week, and I told her I don't expect the Fed funds rate to get above 1.5%. So whether they do that in 3 big raises or 5 raises, however they do it, probably 4 or 5 quarter point raises, and they might start with the half point in March. We'll see. I'm more and more of the mind that they will start with the half point. One, to put a little shock in there and gain some credibility, but mainly because, as I said months and months and months ago, that the whole point of the Fed raising rate is not because they think they really need to, nor that they really want to. One moment, please. The Fed is going to raise rates simply because it needs to reload its bazooka. So they're getting rid of quantitative easing imminently, like in the next couple of weeks. And they're going to raise interest rates to about 1.5% on the Fed funds rate because, one, that'll keep rates from inverting. Because inverted rates are bad, usually cause a recession. That's about as high as they can go without causing a recession. And there's no reason to cause a recession. With the Fed funds rate at about 1.5, 2-year Treasury at about 2, 10-year Treasury at about 3, that would be fairly healthy. Would help the dollar continue its bull market that it's been in for 10 years now. I know there's another narrative out there that the dollar is crashing, but I've showed you that chart over and over again. Dollar's not crashing. Dollar's been gaining strength against the basket of other major currencies for a decade. As I said it would on Market Watch a decade ago, pretty much right at the bottom. So if the Fed can't really impact inflation, what is going to happen? Pretty much what I'm telling you. But the narratives keep coming out. Thomas Petterfy over at Interactive Brokers thinks that interest rates need to go to 4, 5, 6%. And he would, because he is the definition of an Austrian economist who's been wrong since the 1940s. Great technology platform doesn't mean he understands economics. Bink, he's out of there. Even over on CNBC, which is the shills, for the most part, of the mercantilist, with bowing gestures to the Austrian economists who've been wrong since the 1940s. Federal Reserve's actions won't provide much relief for months. Well, it's interesting that they're saying the Fed's policies won't impact inflation for months, when that's exactly what the Fed is saying about oil and supply chains. Second half of the year, supply chains and oil are going to both loosen up. Inflation will come down. That's the Fed's statement. But the narrative of the financial media and the know-nothings on Twitter is that somehow this is all on the Fed. The Fed pumped it up. The Fed's got to bring it down. And again, bullshit. It's just not how the economy works. Not as much anymore anyway. Inflation is caused by certain factors, and oil is the main one. For now, 10 years from now, this won't be true. We might be seeing the last oil inflation ever. In fact, I would bet on it. I think this is the last time that oil pushes inflation up like it did several other times in the last 50 years. Everybody thinks about the late 70s, but I would also point out to the period just before the financial crisis. This guy's got it right. The price of oil is, in fact, what's fueling inflation. But wait, don't just believe our narrative, the guys that are actually correct. Let's look at the data. Notice anything? Energy is what's driving up inflation because it pulls up all these other things as well, because you need energy to do anything else. So an energy inflation is in the 20s and 30s, which depending on your rolling period, the last 18 months is what it's been, it pulls everything else up. This chart makes it pretty easy to see too. Look at energy. That is the cause of inflation. Did the Fed cause that? How would the Fed cause that? How would the Fed cause that? They didn't. So between energy being manipulated higher and supply chains adjusting on the semiconductor side in particular, and a bunch of ships sitting on the ocean to try to get higher prices for what they're delivering, it is actually pretty easy to see that the Federal Reserve didn't cause this, and neither did the other central banks. Their actions kept us out of a depression. And it always kind of amazes me that when people pound the table, central banks and Federal Reserve, blah, 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 wrecking the economy, what would you have had them do 2 years ago? Would you have said, well, let's just have a depression? I'm okay with a depression to last a few years till we get COVID under control. Any one of you? Bueller? Any of you wanted a depression instead of the interventions? I think that's a question that needs to be asked of anybody who wants to blame the Fed and the central banks for inflation. The evidence and the data say otherwise. If evidence and data make any difference to you, then look at this chart and absorb it. Energy pulled everything else up. We know statistically it's about half of inflation. So of the 7.5% inflation, which may have peaked already, half of that is from basically higher oil prices, which pulled up natural gas prices, which led to more people demanding coal, which made it harder to farm because of all the industrialization there. Semiconductor shortages, which drive everything tech, which is over half of the economy now. Just a shade over half of the economy is tech. Basically, oil and semiconductors are somewhere near 70% of the inflation. Okay, so 70% of 7.5%, suddenly you're at a 2% inflation rate when you do that math. And that's the target. So once Intel is pumping out semiconductors and Taiwan Semiconductors expansion in America is pumping out semiconductors, and Exxon and Chevron are producing another 700,000 or 800,000 barrels a day of oil, which is what they said they'd be doing by the end of the year. Another 300,000 or 400,000 from other Permian players, and Africa having a couple of countries coming back online, and Iran looking to cut a deal so they can pump out a couple million more barrels a day. You suddenly go, maybe inflation is transitory. As I said back here, first week of the year, inflation is transitory, and it'll come down the second half of 2022 and the first half of 2023. And remember the year-over-year comps. It took oil going from zero to to over $80 a barrel to cause this. Would we expect oil to go to 160? Well, that's what would have to happen. And could it, for just a hot minute, the way that it got below zero for a week or a couple days, whatever it was, could oil get to 150? Sure, for a little while, maybe for a month, maybe in July, maybe next week if Russia starts blowing things up into the Ukraine, if they actually go all the way to Kiev, rather than just taking the breakaway regions. And I will give you a solution for the Ukraine. This is what the Ukraine should do and what Russia should do. Russia should cut a deal with Ukraine to allow the two breakaway regions to buy their independence. Just like we bought this little place called Alaska from Russia. Those breakaway regions are never, ever going to be a proper part of Ukraine, ever. So why doesn't the Ukraine say, hey, we'll sell these, bring in that money, tell Russia we're never going to join NATO, but you can't tell us that we can't defend ourselves, but we won't put in intermediate range weapons. We'll just have our own force to protect our border. And by the way, we'd like to be a free trade zone between Russia and the West there. I just solved the Russia-Ukraine problem. I can tell you how to fix the Major League Baseball lockout too, but they're even more hard-headed than Putin. So oil prices and U.S. inflation rate. Just to make this really clear to you, look. Those lines track almost perfectly. Price of oil is red, CPI inflation is blue. Can I make it simpler? I don't think that I can. When the price of oil starts to come down or even just level off, right? Even if it just levels off, that means that the year-over-year comps don't change and inflation goes down. Oil from 80 to 80 to 80, there's no inflation there. All of a sudden, as I demonstrated a minute ago with a pretty simple equation, you get inflation back down to about 2%. And why is inflation perpetually low? Demographics. Demographics are destiny. Somebody says the Major League Baseball owners won't like my solution. No, they won't. You're right about that, Vince. But the players wouldn't either, not as much. Owners probably like it less. Part of my solution for Major League Baseball is they freeze ticket prices for a year. See, if they froze ticket prices for a year, they would be doing something for the common man in a period of inflation by helping them still get to baseball games. But no. Can't do that. We're going to have the DH instead. So back to our narratives on inflation. The Fed's normal weapon is to raise interest rates. Business Insider is telling you that's probably not going to work. I agree with them. They want to reload their bazooka, but they don't want to cause a recession. This is all about supply chains and oil. Mostly oil, right here. All the measurements are saying that to you. So don't get caught up in the narrative that this is about the Fed. Now, the Fed is going to use the narrative as cover to get the Fed funds rate up to about 1.5%, maybe 1.25%, 1.5%. That's where it's headed. Probably by summer. I don't know if it'll be by July, as St. Louis Fed President Bullard is saying. Bullard. He's been wrong about a lot of things too, but it's weird what he says and where we get to. What he says is usually wrong, but where we get to is usually right. It almost seems like he's lying to us, because I've been watching him do this for a decade or longer, a long time. It's almost like the Fed is trying to get to a point, but knows or feels that they can't tell us the truth, that they have to manipulate us. I can't believe that's the case. I can't believe they don't trust us, that they want to manipulate us. The Fed, no way. In any case, 1.25% to 1.5% on the Fed funds rate, and I will say it right now, they probably will not roll anything off the Fed balance sheet other than expirations for a very long time. They're not going to buy anything back. They may not reinvest things that come due, and that'll be the only runoff. That'll be the only quantitative tightening. Imagine what would happen if the Fed actually did quantitative tightening. The dollar would fly rather than just drift higher over a decade. And it's going to drift higher over the next decade, just like it did over the last decade. Because in the post-oil world, all these things do play together. In the post-petrodollar world, we're going to let the dollar get stronger. So in the post-petrodollar Bitcoin era, post-gold bug, which really shouldn't be the case, because physical gold is getting really interesting. It's going to hit that $3,000 mark that I said 2 years ago, probably in the next 3, 4, 5 years. But the dollar, in an era where technology rules on one side of the barbell and resources rule on the other side of the barbell, a strong dollar is going to be very good for our standard of living, especially if we're at full employment. And from a demographic standpoint, it looks like we'll be at full employment for a really long time, excluding financial events that cause recessions. I agree with Thomas Lee over at FS Insights. I think that we are about to see a very long-term economic expansion as we rebuild the world. Again, Biden stole Build Back Better for me. I maintain that. You guys all heard me for years saying rebuild the world is how you save it. You rebuild the world in a sustainable way in the post-oil era. And in that era, the dollar gets stronger and our standard of living goes up with that. And we become a much, much better version of Europe without the cool buildings. That's what's coming. What happens in the 2040s and 2050s? Basically, we burn up. But, until then, probably be all right. And in that post-oil world, post-petrodollar world, where the dollar is firm and winters are scarce and water needs to be managed, I'm buying real estate in the Great Lakes region, just like Intel just did. I've been dropping that for 2 years now. If you really want to invest in good real estate, sell your house or your second property in the Phoenix area, because that's going to be one of the worst places in America to be over the next 20 years. And people want to tell me that's not true. They're blinded by living in vacation land. Phoenix is going to get hotter and hotter and hotter by virtue of where it is geographically, and water is going to get more and more scarce. Their lakes down there are so warm that they're developing bacterias that kill people who jump in. It's not a good situation. And there's other places, but Phoenix is the major city that I think is in major, major trouble. So if you have a property in the greater Phoenix area and you like the desert, move to Nevada, because they have more water rights and more water access, and the casinos are going to support that city, Las Vegas. All right. Someone out there has it right. The Fed has to not panic about inflation, and I don't think they will. If you've been paying attention to Powell, he's made it very clear that he's not panicked. He's just biding time. He's going to reload his bazooka in the gentlest way possible. It's still going to roil the markets, but he knows that we're basically at peak inflation right now. Could go a point in either direction, chop around for a few months. But by the end of summer, when drive season is ending and more oil is coming online, inflation is going to be heading down significantly by Labor Day. And about this time next year, inflation will have a 2-handle. So you go ahead and mark that. By this time next year, inflation will have a 2-handle. Now, I've been talking about this since December, right? I backed off for about a year. I started bringing it up in December. Large caps are in big, big trouble. So here's the chart book. Publish it right to Seeking Alpha for free. Go ahead and take a look at this. First major support for the S&P 500 is a little bit under 400 on SPY, 380s, 390s. And then the major support is in the lower 300s. So upper 300s and lower 300s. And it would take probably an event to get us into the Jeremy Grantham zone. He said 250 in an interview recently. And this broadening megaphone pattern, that's your end of the world, jump on a spaceship to Mars line. Could we get down to around 200? We could, but that would be end of the world stuff. Something happened to make this happen. One of the things that you should just keep on your radar is the way that viruses work. When viruses spread easily, they tend not to kill that much. But when viruses spread in a more contained fashion because of vaccinations or natural immunity that you may have gotten from having the virus and survived, the next strain of the virus is usually more deadly. So this fall, going into next winter, keep on your radar that there might be a very deadly form of COVID. And it might only infect 20 or 30% of the population, right? Your unvaccinated group that still goes out in public. But it might kill a third of them. So fewer people infected, but somewhere between a 1 in 3 and 2 out of 3 chance of dying. That's not uncommon for viruses. And while I have given up telling people they should get vaccinated because the wall that people have put up in their heads against this vaccination, I don't know how to argue with it because facts and data don't seem to matter. But if you're not vaccinated, I'm just letting you know the nature of viruses is that they get worse if they can't spread easily. Everybody knows that wants to know that can read. So if you're not vaccinated this fall, you better hunker down if this actually happens. And I would say that it's no worse than a coin flip to happen. And there are, somebody mentions in our chat, there already is variations that are much more deadly. So will they spread and kill more people? It might. Anyway, back to the stock market. We can see this is rolling over, right? That's easy enough to see. And right there is a very important support level at about 430. This is not a retrace for another wave up. If it breaks this level, which I believe it's right at today, at 436.20. So right there, this level right there, 433, 432. Doesn't have to go down much. If it breaks that, you might get a little jitterbug, and then it's going to head down to here. So we'll see. Does it bounce? It might. But then if it doesn't break this to new highs, then it's just going to come back down in a couple different pieces. When we talk about Elliott Wave, I just want something for you to think about. I want to give you something to think about, is that there's longer term and shorter term Elliott Wave. So within a long Elliott Wave, there's shorter Elliott Waves, and then a shorter Elliott Wave, and then a shorter Elliott Wave. Fractal, that's called. The pieces within the parts within the pieces. So where here you can see the different waves, the big ones, right? 1, 2, 3, 1, 2, 3, 4, 5, depending on how you're going to measure it from where to where. I've always said that 2015-16 is basically your starting point. But then all these little wiggles in here, and then the wiggles within those wiggles, the smaller moves within the medium-sized moves within the longer-term moves. That's why I use charts that measure different time frames, hours, minutes or hours, half days, right? The 4-hour chart you've seen me throwing up there, daily, measured at the end of the day. This chart is measuring the end of each week. So if Friday closes, the monthly chart would measure the end of each month. So 12 periods in a year. If you're measuring weekly charts, 52 weeks in a year. Daily charts, how many days in a year? Trick question. 252 or something, right? Only 5 business days. So a year ago, when I was saying that a whole bunch of stocks were going to drop 50, 60, 70, 80%, people told me I was out of my mind. Teladoc, Palantir, Roku, who I told you I didn't like their business model in the first place. Bookface, Zoom, who I think we should be looking at buying. Palantir, I'm accumulating right now. Square, looking for that last move down. Maybe we're there. Rely on Shooter for this. And this is something we cover in the new YouTube service for $1.99 a month. PayPal, ARC. There's a lot of stuff out there that's coming back to reality. Reversion to trend. When I said that I thought ARC would get to between 80 something and 62, people unsubscribed. You're out of your mind, Spano. Look, I've been doing this 25 years now, 26 years now. It doesn't change that much. Things are cyclical. Hype rallies are hype rallies. Trough of disillusionment collapses or trough of disillusionment collapses. We can overlay the Gartner cycle. Look, hype, collapse. Little bounce, people saying, it's back to normal. Then it collapses again. This is almost identical to the Gartner hype cycle. Overlay it. Now all we're doing is trying to figure out, okay, how good is this business going to be over the next 5 years? Well, this one, not much difference. How good is Square or PayPal or Zoom or Bookface, Roku or Palantir or Teladoc? Which companies are going to be the winners coming out of this? Which ones are going to go back to their highs and then set new highs? I'd say Teladoc, but it'll take a long time. Palantir, I laid out the thesis for that this week. You should be accumulating it. Roku, I don't like. I think it's going to be relegated to the outcompeted dustbin of stock history. Bookface, I think it'll be worth something down the road. I don't know how low it could go. Long time ago, I said it'd get back down to around 100. I backed off of that. Now I'm thinking about it again because Facebook is not doing well at all. Go to revenues dropped 25%. People leaving the platform because they don't like their friends anymore, which is the stupidest part of what's going on politically in America, by the way. When you have politicians openly talking about divide and conquer, it's time to sack them. It's time to vote them out, even if they're in your tribe, because they're evil. And I'm not saying Facebook is good. I'm just saying that if we're going to use social media, we shouldn't allow divide and conquer. I think that Facebook ends up being a big deal in the metaverse at some point, but I think that's years away, and we need to look for the final flush. I don't think this is it. Zoom, they have a great business in general. We're doing it right now. We're Zooming, and they have a cloud business and a VoIP business, the cloud in particular, that's going to be a really big deal. Square, this is a way that you can get exposure to blockchain and Bitcoin without having to buy it directly if you don't want to. And ARK, I will tell you, I like the stocks she picks out for the long term, but she has proven to be a pretty mediocre trader at best. When her fund was up here, she should have trimmed and simultaneously said, this is why I'm trimming. And I'm going to sell long-term puts to get these back at a lower price and collect income right now. That's what she should have said, but she didn't. And she won't because she's stubborn. And the next hit for ARK is probably when Tesla comes down even more. So just like to show you something. When did I put this up? Oops, put that there. I put this up in November, it looks like. How do you like my Elliott wave? It's not bad, is it? Let's compare this one to Ford. Folks, this is why you want to buy the $1.99 service. Did it pop up? Ford. There you go. Look at Ford way down there. I think they're going to converge. I think Tesla gets down in here. I think Ford gets up in there. Why? Well, Tesla, the analysts are saying they could see Tesla selling 10% of the cars in the world by the end of the decade. It's a long time. But I think it's a good number because 10% is what I said when? 2 years ago. 2 years ago, I said Tesla get to around 10% of market share. And I'm also saying that Ford is going to be the biggest. They're going to be 12, 13, 14, 15%. Ford has some legacy expenses that Tesla doesn't have, but Tesla has to ramp up to keep meeting demand. So they have CapEx coming too. Why shouldn't they be similar prices? Similar market caps. The market cap of Tesla and Ford are going to converge. And by the way, Ford has that amazing real estate portfolio that will benefit from supply chains moving and fourth industrial revolution technology that they can leverage in different ways, partnerships, just new businesses outright. So Ford started the day down today and now the darn thing's up. I just can't get it at 15 or 16 anymore. I hope. All right. So one last thing on earnings. Companies are beating earnings basically the way that they always do, but the outlooks are coming out worse. The outlooks that the companies are putting out there, I haven't seen the measurement of it yet, but it's out there and I'll find it. I go to FactSet or something. The outlooks for earnings over the next quarter and 12 months are about the worst I've seen since the financial crisis. So that means that you may see earnings not go up in the next 12 months. At a minimum, there's probably a 3 or 6 month period that's pretty bad. So I'm just going to reiterate my call for this year. I believe that this year will be a lot like 2018. Tough early part of the year with a rebound, and then we'll sell off at the end of the year. And it'll probably be a bifurcated sell-off. Losers will lose more, and the winners will hang in there. But your losers will probably outnumber your winners 2 or 3 to 1. And if you're looking at the advanced decline line, the way that Bonnie Gortler does, she's our MACD expert, then you know that that's pretty much what's already starting to happen. A lot more losers right now than winners. And the Great Divergence, which I named after Aaron Rodgers and Shailene Woodley, rather than calling it the Great Bifurcation, because I think that the word bifurcation makes people think of soda or something. The Great Divergence. Sometimes real life imitates reality even better than fiction, right? Yeah, that's right. I studied Yogi Berra too. So Aaron Rodgers and Shailene Woodley were engaged and now they're not. They've had a divergence. And she, of course, is the divergent actress. All right, I know. It's not that funny. In any case, the great divergence, what is it for stocks? It's the correction that the zombies don't get up from. So the next correction, which is happening right now, the zombie stocks, the ones that people wrote up because, oh, look, they're going up, and I'm going to grab onto the narrative that the traders gave me, even though it's not true. When they get on the mat next time, they're not getting off the mat. They're going to chop along sideways for years. And the ones that can turn around will rise again someday. But remember, what do we know about turnarounds? They rarely turn. Very few of the zombies will survive this decade. Maybe 20%, give or take. Let's apply the 80-20 rule. 4 out of 5 zombies will actually die someday. So I wouldn't be gambling on too many zombies. All right. Any questions? Somebody asked, Kirk, do you think the lows in the stocks that we want happen in Q2 or Q4? Yes. All right. I think you get 2 chances. And if you want to make some cyclical trades within the, some short-term cyclical trades within the more intermediate term cyclical trade, that's why I talked about that. Periods within periods within periods. There are some trades that you can make, and they'll last a few months. Buy the first correction, sell a rally, buy the second correction. But the companies that you really want to own for the next 5 years, don't trim back to zero. Trim back to a starter. Yeah, I have so many. Somebody asked, can I write more articles like the one I did on Palantir? That is actually the format that I'm going to do going forward. It's a What the Market is Missing series. I haven't decided if I'm going to try to brand that title, but I don't like regurgitating what other people are writing. I don't like just transferring from somebody's corporate report over to an article. I can just link you to the corporate report. You should look at the whole thing anyway. So my articles are going to focus on what I think the market is missing. And I'm not going to regurgitate earnings only to the extent I'll talk about earnings and growth and things like that to really emphasize a number. But I'm going to link the investor presentations. And that is what you should look at before you read my articles. Because I will tell you what I think the market is missing on the positive side and the negative side. So with Roku, was it almost a year ago I told you that Roku's going to have big problems? And it was because of competition. And they were overvalued. Same thing with about a year ago. I said, I kind of wonder if we're at peak Amazon. And now Amazon has chopped along for a year. I would buy Amazon on correction, though, for sure, because I think that they're going to split up into 2 or 3 companies at some point. And when that breakup occurs, a lot of value will get unlocked. And by the way, the cloud business is going to grow 400 or 500% this decade. That's why Google and Oracle and Microsoft all jumped in. Yeah, so Square, I will tell you what the market is missing is that Bitcoin truly is digital gold. That's how it's going to be regulated as a commodity. You're not going to be able to use it as a cash substitute because every single time you sell some, you're going to have to file taxes on it. And that would be burdensome to use it to buy your pizza. But if you want to buy it as a store of value, then it's going to be worth something. And if they regulate it consistent with what I'm talking about, that means that Bitcoin will be used for international transactions, and family offices will use it as one of their stores of value. And so will corporations, but family offices more than anything, I think. And this idea, so I've been watching the Twitterverse here for all week. Between them somehow making the trucker thing in Canada about Bitcoin and somehow making the Ukraine about Bitcoin, it is amazing to me the A, lack of ethics, and B, lack of brains that is out there with regard to how blockchain and the crypto universe works. And there's going to be a lot of people that lose their shit when Bitcoin goes down to around 20-something thousand a share. And it's going to. But at that moment, family offices, who you can track in Institutional Investor magazine, are going to get more into Bitcoin. Why? It's a store of value. There's a limited amount of it. It's easy to transmit. You can put it in cold storage just like you can gold. You've got the lunatic fringe out there that's always going to bid it up when it falls, after they lick their wounds. Never underestimate the madness of crowds. A couple charts to remind you, right? Which part of this is the madness of crowds? Is it the rise or the fall? Depends on what you think the company is really worth. All right, let's call it a day. Say goodbye to my 2 long lost pets again. And I think that if you were positioned in cash, 30, 40, 50% cash, like I've been pushing you to do for 3-4 months now, 5 months now, if you got to that point, you have to take a breath this weekend, do some yoga, meditate. Don't stare into the sun, though. That's bad. And read my 2 articles coming out on Monday, my 10 favorite growth stocks and my 10 favorite dividend stocks. And you need to be nibbling in on these corrections. And I will say, just everybody's fretting about Ukraine right now. I think that might have run its course already, mostly. A lot of risk off this week already. So if you haven't bought anything at all week, find 5 or 6 stocks today. Intel, Palantir, Square, PayPal. I'm looking at the list right now. Lumen Technologies, AT&T. If you don't own those 6 already, sell a put or buy some of the stock, teeny tiny amount, just enough to get a starter position if you don't already have those. Just a placeholder. Just so, in case this market goes straight up and we get this rebound rally that we're expecting at some point, you bought at least a little something. Because remember, stock market goes up 80% of the time, and you can't pick absolute bottoms all the time, really ever. So part of your scaling in process has to be, I'm just going to nibble in just a little bit. I'm going to hold my nose. If it goes down 20% more, I'll buy just a little bit more. Buy a fractional position, 0.25%, 0.5% of your portfolio in those 6 stocks if you don't already have them. You don't really need to average down any further or add if you're already at your proper asset allocation. And what I will tell you is that with PayPal and Square, I treat them as one position. So if I want to get to a full position, which is 3 to 4% for me, each Square and PayPal will each represent half of that. So I wouldn't buy 3 to 4% of both of those over time, but combined, I might get the 3 to 4% eventually. So maybe 0.25% of each right now. I've already sold a couple puts. You could do the same thing in alternative energy. I have that article in the waiting room. Got to finish that. Alternative energy, I'm buying PBW. Then I'm adding a little bit of SunPower, a little bit of Sunrun, a little bit of Solar Edge, and a little bit of Enphase at certain prices. None of those will get to be a full position, I don't think. Maybe SunPower. But Enphase and Solar Edge, I consider one position broken into 2 parts. Sunrun and SunPower, and I might add another solar company, one position broken into 2 or 3 parts. And then PBW as my core alternative energy holding. That's how I'm looking at things. What's my core position? That's an ETF. And then am I going to add 1 or 2 stock positions? Emerging markets, same thing. I'm going to use EMQQ. And if I were adventurous, I'd buy a little bit of Alibaba and Jumia and Stone. I'm probably not adventurous enough to buy Alibaba, but there's people who are convincing me to go back to it. I don't know. It's like an on again, off again boyfriend-girlfriend relationship. I hate those. Never did those. Anything that started out that way, I ran the other direction. And it worked out all right. Back and forth. I have a hard time with it. All right. Have a great weekend. And I've got a lot of content coming still. You will have noticed that it's been ramping up a bit. And I don't like to overwhelm you with too many words to read because there's just so many minutes in a day. So the streamlined approach to the articles that I'm putting out there with links to the 2 or 3 things that you need to pay attention to and get your background information. And then I'll tell you what I think the market is missing, either good or bad. Then you can make your decisions from there. All right. Have a wonderful weekend. There's no football. There's no baseball, even though they're supposed to have reported this week. We're not quite the March Madness. I don't know. Maybe read a book. Weird. Reading a book. All right. Have a great one.